Okay, so have you ever actually stopped and wondered how a massive corporation tracks where every single dollar goes? Well, in this explainer, we're going on a pretty fascinating journey. We're going to start by looking at the overarching structure of a business from a really wide macro perspective, and then we'll meticulously zoom all the way in until we are examining the precise cost of a single everyday product. It's an incredible process, honestly, and it takes us from the abstract ideas of management right down to the tangible dollars and cents that make our economy tick. If you've ever wanted to truly understand the anatomy of how businesses measure their own survival, you are absolutely in the right place.
I mean, think about it for a second. If you just gather 50 random people in a room, you don't magically have a business, right? Just have a crowd. You have a lot of potential for complete chaos. So what exactly separates that chaotic group from a functioning, profitable enterprise? The answer lies entirely in structure. It's all about how that group organizes its operations and, critically, how it understands and tracks its costs. Without a clear business and cost structure, even the greatest product idea in the world is going to financially collapse. And this problem-solution framework is exactly why mastering cost accounting and organizational design is absolutely essential.
Okay, let's dive straight into this. Here is our macro to micro roadmap for today. First up, we'll look at the anatomy of an organization. Then head inside the office, navigate cost centers, break down the mechanics of costs, and finally, we'll look at direct costs versus overheads.
All right, Part 1, Anatomy of an Organization.
Let's start at the widest possible lens. This formal definition is the absolute bedrock of everything we're talking about today. An organization isn't just a physical building with a fancy logo slapped on it. It's a highly intentional social arrangement. It exists to pursue collective goals, meaning everyone is, ideally, pulling in the exact same direction. It controls its own performance, and crucially, it has a strict boundary that separates it from its external environment. That boundary is literally what keeps the chaos out and the structure in. You are either inside the organization working toward its goals, or you are outside of it.
Because when we hear the word organization, it's super easy to just picture some towering corporate skyscraper or a really bustling retail store. But it goes way beyond that. Clubs, hospitals, schools, and government agencies are all perfect examples of organizations. Even though your local soccer club isn't exactly chasing corporate profits like a Wall Street firm, it still has collective goals, performance controls, and a clear boundary of members. They all require an administrative structure just to survive.
Let's move in a bit and see how this builds. Part 2, Inside the Office.
So as we shrink our focus slightly, we realize that every organization absolutely needs a brain, a central nervous system. And that is the office. Now, the office isn't just a room with desks and a water cooler. Fundamentally, it is a dedicated center for information and administration. It acts as the ultimate command center, ensuring that vital data flows to the right people so that faster, much more controlled decisions can be made. By centrally managing this information, the office saves the company an immense amount of crucial time.
To keep the chaos totally at bay, this central hub gets sliced up into specialized departments. You've got finance and accounting crunching the numbers, you have purchasing bringing in the raw goods, sales and marketing are out there trying to drive revenue, then you have the critical internal functions, wages and salaries ensuring employees actually get their paychecks, information technology keeping the digital lights on, and human resources managing the people. These departments handle all the vital daily duties, like making sure customers get billed and orders are placed that allow the collective goal of the whole organization to actually be reached.
But seriously, how do all these totally separate departments stay on the exact same page? Enter the policy manual. This is the strategic rulebook that dictates the required procedures for all these various office functions. It guarantees that all personnel actually follow best practices. Because without it, the purchasing department might use entirely different software than the finance department, and that leads to a complete breakdown in communication. The policy manual ensures everyone is speaking the exact same operational language.
Which brings us to Part 3, Navigating Cost Centers. So, we've got an office running smoothly, policies are set in stone, departments are humming along. But here is the critical pivot. How do we keep track of the actual money it takes to operate all of this? This brings us to a huge tool in accounting, the cost center. Before a business can ever figure out how much a single product costs to make, it has to group its expenses. A cost center is exactly that. It's a physical location, a department, or a function where costs are first accumulated and analyzed. Think of them as massive staging areas for expenses. The money you spend doesn't just vanish into thin air, it gets caught in the net of a specific cost center so management can look at it and say, okay, this is exactly what this particular department is costing us right now.
To make this a bit more concrete, imagine your business groups costs into massive buckets like a production cost center, an administration cost center, or a marketing cost center. Every single time the marketing team buys a new online ad, that expense goes straight into the marketing cost center bucket. Every time the factory floors use electricity, boom, that goes into the production cost center. Eventually, all these accumulated costs will be carefully analyzed and then charged down to the actual items the business produces.
All right, let's keep zooming in. Part 4. The mechanics of cost.
We've looked at the giant buckets, so now let's zoom in even further to the absolute fundamental building block of management accounting, the cost unit. A cost unit is simply the specific unit of a product or service that the business is actually making or selling to which a cost is attached. If you're a local bakery, your cost unit might be a single loaf of bread. If you're an accountant, your cost unit might be 1 hour of consulting service. It is the core baseline thing that you are tracking the expense of.
Let's anchor this jargon to something real so it's instantly tangible. If a construction supplier sells bricks, a single brick is a cost unit, maybe priced at $5 per unit. For a clothing retailer, a shirt is the cost unit, perhaps at $60 per unit. Or a cost unit doesn't even have to be just one single physical item. It could be a pack of 10 pens, treated as one unit, costing $100. Whatever the customer buys is the unit we have to attach our costs to.
So the crucial point here is understanding what we actually mean when we throw around the word cost. Cost represents the entire financial effort, all the expenses carried out to buy or make that one single unit of a product. It is not just the plastic used to make the pen, it's the effort, the time, the factory space, literally everything required to get that single unit ready for a customer's hands. Let's look at this super simple, solitary number for a second. $5. If a customer buys a single marker from a shop for $5, then to that customer, $5 is the cost of that unit. And this brilliantly illustrates the cost per unit. It's the most distilled, final mathematical conclusion of all those massive organizational efforts we've been talking about so far. Everything the company does boils down to delivering that unit at that specific cost.
This takes us to our final stop, Part 5, Direct Costs versus Overheads.
Now, how do we categorize the specific expenses that actually make up that $5 cost? Well, every single expense a company faces falls into one of two very distinct camps: direct costs or indirect costs. Direct costs are completely physically tied to making the product itself, like the direct materials used, the direct labor of the person assembling it, or the specific transportation costs. Indirect costs, on the other hand, are the general expenses of keeping the lights on. We're talking rent for the building, utility bills, or indirect materials. You can't easily trace exactly how much of the monthly factory electricity bill went into making one single $5 marker, but you know that electricity still has to be paid for.
Now, here's how accounting solves the headache of those tricky indirect costs. Because things like rent and utility bills can't be easily traced to a single cost unit, they're all grouped together into a master category. All indirect costs are accumulated under one massive head known as overheads. So when you hear a business complaining about their overheads, they are talking about the heavy, indirect financial burden of simply keeping the organization running.
But overheads aren't just one flavor, right? We actually classify them even further into production and non-production overheads. Look at how a factory floor item differs from an administrative burden. Machine oil, glue, and a factory supervisor's salary, these happen inside the factory itself, so they are production overheads. But a sales manager's salary, an auditor's fee, or an advertisement? Those have literally nothing to do with the physical manufacturing process. Therefore, they fall into non-production overheads. It's a beautifully organized system to make absolutely sure no expense slips through the cracks. And that brings us to the ultimate goal of this entire system: cost management. Mastering all these classifications, from defining the macro boundary of the organization all the way down to tracking a micro-production overhead like glue, is the true core purpose of management accounting. This system is what allows a business to establish accurate budgets, set standard costs for their operations, analyze variances when things inevitably go wrong, and ultimately determine their true profitability.
We have traveled all the way from the abstract definition of an organization right down to the literal machine oil and glue that makes it run. So, I'm going to leave you with a quick challenge. The next time you buy a product, whether it's a $5 marker, a $60 shirt, or just a simple loaf of bread, take a close look at it. Can you figure out what its direct costs were versus the massive hidden structure of organizational overheads that made it possible for you to hold it in your hand? Keep that analytical lens sharp, and until next time, stay curious.